You are new, welcome, and thank you. We would love to get to know you. We offer a complimentary discovery meeting to show you how we can assist you on your path to success. So give us a call anytime. One of the areas our firm excels at is focusing on taxes as a part of your overall financial plan. We aim to deliver personalized financial accumulation and distribution strategies by blending the relationship between our CPAs and on-staff full-time financial advisors. Our process begins with a holistic approach based upon the review of your personal financial planning needs unique to you and your family. The more we understand your vision and goals, the better we can help you prioritize meaningful progress. As a reminder, during the call today, feel free to use the Q&A button at the bottom to submit any questions that you may have. We'll field them after the presentation. All right, let's get to the main event. I want to introduce you to our speaker today, Mark Eibel. He is the Director and Chief Investment Strategist for Russell Investments. He has been with Russell for 38 years and is a regular on CNBC and Bloomberg TV discussing economic trends and opportunities. Our firm works with Russell out of Seattle to provide our clients with the most tax-efficient portfolios we can. We have collaborated with them on a number of specific portfolio designs and value our partnership with their team. They were kind enough to offer our tax and financial services clients and our team a quarterly economic update, and we look forward to today's presentation. All right, Mark, welcome in and take it away.
Thank you much. And we'll get to a little election talk at the end. We are certainly running up against deadline with that one. So next quarter when we talk, I'm assuming we'll know the winner. So we'll be able to at least stop saying what this, that. We'll actually kind of know the hand we've been dealt. But we'll talk a little bit more about what hand that might be in just a few minutes. A good quarter for third quarter. Boy, everybody did well. Everybody made money. Bonds had a really big rally. So when interest rates drop, the value of your bonds goes up. Equities did well. I mean, just about everybody made probably 5 or 6% in third quarter. So the beat kind of goes on for the year. Balanced portfolios, somewhere around 60% equity, 40% bonds, up depending on the day, upper single digits or lower double digits. Very consistent, by the way, with what markets do in election years. So for all the fear and anxiety out there, people don't usually manifest it, at least the markets don't manifest it in returns, and this has been consistent. So this is a slide. It's funny, after the first half of the year was really strong, and we had a slide that said, well, when markets are this good, usually you want to stay in the game. Markets do just fine in the second half of the year, and this is just kind of a continuation of the theme. Well, what about when you've been up this strong for 3 quarters? Again, history is on your side that markets will continue to trend up. Are U.S. markets expensive? Yeah. But valuation or just looking at price is usually not a really good timing tool, meaning markets can be overvalued and continue moving up for long periods of time. Usually it takes some sort of event in order to drive them down in any sort of a big way. And we've certainly had some candidates out there. I wouldn't say the economy is a candidate, but we've had candidates out there. Again, it is an election year and the anxiety that comes with that, obviously what's going on in the Middle East, but nothing's really shirked to this market. And so what this shows is just going back through quite a time. Really, you have to go back to 1987. Now, what happened in 1987? Well, all the loss came in one day. That was the day where the market dropped 25%. Early on in my career, I don't think I understood the significance of that in one day. So really, you take away that day, and this pattern has continued. Now, of course, we don't know what fourth quarter is going to bring. Markets are slightly down so far this quarter. We'll talk about what the market reaction might be in a little bit. But if you just use history as a guide of, boy, I just want to get out, usually it's not on your side. And quite frankly, that's a hard way to make a living or make money, right? Because then you're going to have to figure out, well, when do I get back in? And we all get inside of our own heads with that, right? Because you might be really logical and have reasons on why you get out of markets and say, well, if this happens, I'm going to do that. The problem is that when that actually happens, well, we tell ourselves, well, I'm going to wait for this to get resolved, that resolved. And then you end up being out of the market or away from your plan longer than you ever thought. And that's the period that you lose the returns on. So, anyways, we'll certainly know the answer for the fourth quarter results when we do our next quarterly review. But it's been a strong year and it has stayed strong all year. Economic dashboard is not a slide oftentimes I don't hit on it. It's pretty detailed. We've been doing this slide actually since 2008. We created it during the financial crisis when everything was out of whack. Just to say, well, what's normal and where are we at? So what you have on here is a number of market and economic indicators that we think, and particularly in moments of when markets are having tougher times, are things you want to look at to come out. So you've got the extreme values on the outer edges in the numbers. Usually they're 2008 kind of numbers. You've got the blue, which is where 2/3 of the observations are. Then you got the orange, which is the orange box, which is just the current reading, and the arrow is the direction that we're going. So a lot of information on one page. And a lot of times I'll use this to kind of frame my talks on what we might be talking about. And what you see here is, I mean, there's a couple that are out of the norm. Obviously, interest rates are still out of the norm because short-term interest rates, kind of the 2-year Treasury bond, is still yielding more than the longer-term Treasury bond, and that's out of the norm. What you also see on the very bottom is consumer sentiment. Now, it's interesting. We actually got a read on that today, and consumer sentiment has bounced up. Normally, consumer sentiment just kind of follows the market. Kind of makes sense. You feel better when you're making money is basically the answer. Get rid of all the technical jargon. I think that's what drives it. So to see it on the lower end or out of the norm on the low end when markets have done so well is kind of different. I think it's kind of just, it shows it's a sign of the times for even if we're making money in portfolios, we are anxious about things. Some of it's still, I think, just this extraordinary 5-year period, we're still kind of coming out of the COVID period and trying to normalize the world and the data. And then obviously you put an election on top of it. So I'm not too surprised, but that one is kind of interesting. After today, maybe we're getting back up into that blue because again, the reading was pretty positive today. So people must be feeling a little bit better. The other one is the one on the very top. Every single time I listen to a business interview, I think the first part of it is well, boy, in these volatile markets, how are you running, portfolios for clients? Markets actually haven't been volatile. And you see that in the top measure, which is the VIX, which is a common volatility measure of just how volatile is the market. And what you see is it's in the 2/3 of observations, and it's actually at the lower end. Again, we might think markets are more volatile. We still might think in terms of, oh, the market moved 100 or 200 points. That's a big day. It's not a big day anymore, right? It was a big day when we were all younger, but it's not a big day anymore. So you have to zero in on the percentage moves, not the point moves. But again, I think we're all kind of extrapolating out and saying, well, I'm stressed in my life, therefore everything is volatile. Markets have been remarkably calm. And a lot of the volatility has been to the upside. That's kind of volatility that most of us can say we're okay with that in markets. So interesting to see what markets have actually done versus what the perception is of what markets do. So a lot of the other ones are kind of in the zone. We'll talk a little bit about these as we work our way through. The inflation numbers are coming down. We all might not agree with that at home. This one probably has the biggest head scratching for most folks of, well, doesn't feel like inflation's down. So let's just spend a couple seconds on this one. There's the way the Fed looks at the world, and then there's the way you and I look at the world. The Fed looks at everything year over year, and on a year over year basis, yeah, inflation is getting into a much more comfortable area for the Fed, meaning it's gone up. It's kind of in that 2 to 2.5%. That's kind of the area that most central banks in the world want inflation to get to, because it encourages us to spend, because we know if we wait to buy something a year, it's going to cost us more than it cost this year. That's how economies keep going. But it's not so high to disrupt our lives. We also don't want negative inflation. It sounds good, and it's great for us individually. If prices go down, who doesn't like that? The problem is that if prices go down for everybody, nobody really spends, because it's the opposite effect. Why would I buy something now if I can wait and get it cheaper next year? It's kind of the Japan story for decades, quite frankly, right? So inflation, as the Fed looks at it, is kind of in a zone they like it to be in. Well, that's not the way you and I feel, right? And the question I get oftentimes when I'm in lunches and dinners on the road is, Yeah, but when's that spike up, that happened during COVID when we saved all this money and then we spent it and there was nobody to make it. That's how we got it in the first place, right? Too much demand, no supply. When does that go away? Truth is, it doesn't go away. That reset doesn't happen. The only thing that makes that reset happen is if we have a much deeper recession than you and I probably want. And you kind of look at the economic numbers on there, and we're in a 2.5 to 3% GDP zone right now. It's pretty good for the U.S. and we don't see that as being negative, at least not until next year at the earliest. So that spike up doesn't go down. Now, again, be careful what you wish for. If we had a deeper recession, I always think of it this way. My kids are 24, 27, and 30, all employed, all out of the house. I like it that way. Love my kids, love them outside the house, right? So what happens if we have that deeper recession? Well, one or more of them probably lose their job and move back home. So I don't know if that's a scenario I'm rooting for. So again, I know it's not a very satisfying answer. We feel inflation differently. I think the Fed understands that, but what their job is year over year, and moving forward, inflation is more in a comfortable zone. Now, could that change? Sure. Could depending on what happens next week, if Trump wins, if tariff policies go up, could that happen? Sure. I think you're starting to see that in the bond yields. Interest rates have been moving up as of late because people are worried a little bit more about, well, could there be inflation? And it's because people are kind of making bets, so to speak, on what might happen in the election. So I'm not saying that inflation might not come back, but we can't play in a world of what ifs right now. We'll know more of that as we move forward. But as of right now, inflation is in the zone that the Fed is much more comfortable with, whether you and I might agree with that or not. All right, so lots of information on there. For those of you that follow markets a lot, this is always available. You can actually drill down into the real data real time if you really want to get into it. But this is probably the most detailed slide in our deck, and it's in our deck every single quarter and has been for over 15 years now. All right, let's move into some of the more thematic things. Another question I get all the time kind of rhymes with how we started this chat. Well, markets are at an all-time high. Why do I want to invest in markets? Well, kind of to steal a line, conceptually at least, from Warren Buffett. Buffett, has been asked, will the Dow hit 100,000? And he says, sure, just don't ask me what decade. And that's kind of the way I look at all-time highs, right? I mean, look at that chart above. We have all-time highs all the time. We've had over 40 of them this year, higher than the average. You can see the dotted line on the upper half that shows the average. So all we did was say, well, on any given day, you either reach an all-time high or you don't. What do markets do moving forward? And, markets do just fine under both of them, right? And the first bullet point is the one that always surprises me. So going back to 1957, I mean, we're talking what, 60 plus, almost 70 years. You hit an all-time high, about 18 times a year, but that's 7% of all trading days if you get rid of weekends and holidays, right? So 7%, that means about every 14 trading days or about every 3 weeks, going back 60 to 70 years, we're reaching an all-time high. Kind of remarkable if you think about it. It's a higher number than I would have thought, or it's just interesting when you think of it in that terms rather than some just looking at the data above. So I think the short answer is, yeah, I think it's okay to invest at all-time highs because again, what are you really managing towards? It's not the next week or month or year. You're trying to manage your longevity, right? You got to stay in markets. You got to stay in the game. One of the 3 things that you control, right? You control having a plan, you control staying in the game, and you control managing your taxes, as was talked about in the introduction. You don't control a lot of other things that we're talking about here, right? So, time horizon kind of heals all wounds, right? Markets go up over 70% of the time. So, now I understand that people go, well, I might not want to put a lot of money to work at an all-time high. And it's like, well, fine, dollar cost average it in. Or, if you rebalance, sell some stuff that's done really well and buy some stuff that's underperformed. I mean, rebalancing is kind of helps again with this all behaviorally of kind of buy low, sell high without having to make dramatic decisions. But anyways, I just found some data on here interesting, and maybe for those of you that continue to put money into markets gives you a little bit of relief about, and I'll come back to this theme on the very last slide of the deck, which kind of shows once your time horizon gets 5 years and out, you'll just wait till you kind of see some of the results. So we'll get to that one in just a few minutes. All right, let's keep moving through here. We did see a little bit different market in third quarter, quite frankly, a market that we would prefer. So we're starting to see a little bit more participation from something other than 7 technology names, or in this case, we look at the top 10 stocks. I think if you add in the top 10 are kind of the Magnificent Seven, you know, the big technology names. And I think you get Berkshire in there, you get United Healthcare, and I can't remember the 10th name. But I mean, it's been a very concentrated market. Well, we started to see that broaden out in third quarter. I mean, look at the third quarter. The top 10 names were 8% of the market return, almost 92% of it was from the other names. We haven't seen that as of late. So it's a harder market to win in when a handful of names win. Now, we go through periods like this. We've seen a couple of them in pretty recent history where just these tech names dominate, right? I mean, we are the technology kings of the world, and when a new technology rolls out, the creators get paid, so to speak, right? The creators of the technologies get paid, and that's what we've seen. This quarter, what we saw in third quarter is we actually saw non-US companies beating US companies. We saw smaller stocks beating those larger names, which we haven't seen for a while. We saw more cyclical or value or price sensitive stocks beating more growthier names, higher price technology, consumer goods, healthcare kind of companies. Emerging markets came along for the ride. Even in the real asset space, I mean, everybody talks about global REITs, and they always zero in on downtown commercial real estate. And boy, that's going to be a really tough spot. Well, 90% of that index is other things. And that whole index was up 16%. It was actually the leader for third quarter. So we saw a much broader market in third quarter. We'd like that trend to continue. We're just fine if those 7 names continue to do well. We would just like some participation from other names. It's healthier, right? And particularly if you think about, you know, this is your grown-up money, and you know, if you have, say, a 70% of your, maybe even more of your money in US equities of your equity allocation, and if, you know, half or more of your money is in equities, you're looking at a pretty good percentage of your money that's in 7 names for your retirement. I'd like to broaden that out a little bit. And so this was a nice quarter to see other markets participating, and this just kind of gives you a flavor for it on the bottom of the chart. Let's go to the next one. Let's talk a little bit about fixed income. Again, I said fixed income was a good quarter. It's just the math, right? Interest rates dropped. Why? Well, the Federal Reserve reversed engines. They finally did. They told us what they were going to do, at least directionally. Lowered interest rates by 0.5%. Some of us thought they'd do it by 1/4 point, but they decided to do a half. There are 2 inputs that they look at, they're feeling more comfortable with. We've already talked about one of them. First one being inflation. That's the first thing that they have to feel is in more of the reasonable range for them to think about lowering interest rates. And what they're trying to do, it's tough, right? They know it takes about a year, whether they're raising interest rates or lowering interest rates, in order for it to really kind of take hold. So they're basically trying to guess, where's the economy going to be in a year? Good luck, right? That's hard. Hard to do in the US. It's hard to do, harder, I think, to do here than anywhere in the world, quite frankly, because we're 2/3 consumer spending, right? So you have to figure out when you and I are going to stop spending. Good luck figuring that one out, whether you're the central bank or anybody else. So, but they're guessing the economy will be slower. Now, they're not saying it'll be in a recession, and they don't need a recession to lower interest rates. Normally, that's when they do it. They just want to spur economic activity. But right now, they're saying, look, if inflation is coming down, 0 is way too low, but 5 1/4 is higher than they need. So they've started the path to lower interest rates. I don't know the destination, but again, I mean, I think I know the destination, but I don't know the path. I don't know how long it's going to take them to get there, but they're going to get to like 3 to 3 1/4. So if rates are going to move down, you're probably going to have more environments where bonds moves up. And that's exactly what you saw in third quarter. As soon as the Fed would drop by 0.5%, you saw particularly longer maturity bonds. Think of the 10-year Treasury note dropped all the way to 3.6%. That's a pretty big percentage drop. That's why you see what you see on this page. So if you're an active fixed income investor, or you have fixed income or bonds, maybe a more conservative investor by nature, you had a very nice quarter in third quarter. Now, again, those interest rates have moved up a little bit. Market might have overshot a little bit on the reaction. Number 2, again, if there is a scenario for inflation, that'll move interest rates up, and that gets into a little bit about elections. And the labor number since then, that's the other part of the job description of the Federal Reserve. They not only look at inflation, but they want to keep employment going. It was a hotter number in September than they thought it would be. So all of this kind of lends itself to rates have moved up. So you've given some of that return back. But third quarter was a very strong market. We get one more labor number, by the way, this Friday. So, right before the election, we're going to get the last jobs report we'll get before the election. It could be a weird number because we got some stuff going on that might impact it, right? Number one, the hurricane hit. So that impacts what's going on with employment, particularly in places like North Carolina and Florida. The Boeing strike is also going to be a negative input to that as well. If the port strike hadn't been pushed into the next administration to kind of figure out, that would have been a big driver too. And you could have had a really negative number on Friday. So I don't think tomorrow's or the Friday's number is going to move the markets. I mean, it might move markets. It's not going to move people's opinions, I don't think. And it could very well get reversed out once some of these one-offs reverse themselves in the next month. But we'll be looking out for that. The Fed, by the way, meets 2 days after the election. So they usually meet on Tuesdays and Wednesdays. And I have a feeling they probably, and then they vote, they meet on Tuesday and they tell you what they're going to do on Wednesday. And I have a feeling they rescheduled to be more Wednesday, Thursday going. We probably don't want to be the news item on either one of those days. So they are meeting a couple days after the election, and they'll either keep rates where they're at or lower them a quarter point. I still think they'll lower them a 0.25%, but we'll see. All right, that's a little bit of what's going on in bonds. I talked a little bit about kind of a third asset class that is a lower weight in our portfolios, but we always have it. It doesn't always get talked about as much. It's kind of real assets. It's REITs, as I mentioned. And again, everybody always zeroes in on commercial real estate. It's interesting now that more and more companies are going back quicker than I thought to 5 days a week back in the office. Maybe this crisis that everyone had worried about of these big buildings not staying vacant, maybe they won't be. And keep in mind, companies did the same thing that you and I did. If you do have a mortgage, you probably refinanced it over the years and it's pretty low. Well, corporations did the same thing. So they have some time with lower rates before they reset. It'll be interesting by the time those reset if people are back in buildings or not. But beyond that, again, 90% of the index is other things. I always think about all these packages that show up at our doors. They probably were in a REIT somewhere pretty close to you, a big storage unit down the street, and those are doing pretty well. So again, it was the best asset class. Infrastructure is kind of related to it. We all know that there's trillions and trillions of dollars, not only here, but around the world that are going to be spent on infrastructure. You're either rebuilding the developed world, that's us, that's Europe, that's Japan, Canada, and Australia. Or in some cases, in a growing emerging world, you're kind of maybe building things from scratch. Either way, there's a lot of money that's going to get spent on infrastructure. The third piece that we have in our tax managed portfolio is natural resources. It's kind of a way to get commodities. Now, commodities themselves are very tax inefficient, so we do not want to use those in taxable mandates. So what we get at is rather than owning the metal, rather than owning gold, you own the gold miner. It's that kind of a thing. Rather than owning any commodity, you kind of own the stock that kind of represents it or mines it. So all of those together, again, by far the smallest asset class in a balanced portfolio might be 10 to maybe 15% of a portfolio, but we like them because they tend to do better than maybe bonds over time, but not quite as well as stocks. But they're kind of a shock absorber in there. They spit off a lot of yield. They are, again, there's going to be demand in that space, and we like having kind of that additional diversifying buffer. And sometimes you get a quarter like this last one where they actually were leading the markets. Again, they do well when interest rates are dropping. They borrow a lot of money for projects, and so they were a nice piece of the portfolio. So since we don't talk about it very much, we thought we'd have a slide in there for this particular quarter. All right, we've hit on most of the asset classes. Let's get to the fun part. So I travel everywhere. I know where I'm at when I speak. I give the same talk on elections, right? It's all, to me, all I can talk about is what do the markets do. And if you've been listening to these calls for the last few quarters, we've been dripping in a slide every quarter, a different one from our election deck. If those of you are interested, it's about 8 to 10 slides. They all kind of point to the same answer. But if you want some more details on how we kind of slice the data, talk to these guys, and they can certainly get it in your hands. What this one just looks at is, well, what do markets do in election season? And as I mentioned, markets tend to do pretty well. This only goes back to 84, but if you go back to the 40s, and look at a kind of a 60-40 portfolio, there's really only 3 election years that the market's underperformed. And I don't think any of them had to do with the election. It's the launching of World War II. It's the 2000 tech crash, and it's the 2008 global financial crisis. Again, all happened during election years, but the election, I don't think, didn't cause it. What this also shows is what do markets do the next 3 years? And as you can see, markets do pretty well after that. So don't mix your planning with your politics is usually the answer that I come to. The common question related to this that is in that deck is what's the magic combination? We've probably talked about this in the past. There's 16 different ways that we slice and dice party in charge of the president, the Senate, and the House. And in 14 of those 16 kind of makeups, and all the observations but 2, the market's up somewhere between 8 and 20%. It likes mixed party the best, but it does just fine under straight control by either side. And basically, once it knows the answer, and I would like to know the answer, I don't know if we'll know it this particular election, simply because of the amount of mail-in votes, as well as the hurricane issues, particularly in North Carolina. But once the market knows the answer, it tends to do pretty well. Related to this, I think there's 2 scenarios that'll probably one or the other will play out. Number one, interestingly enough, there's one scenario out of all those 16 that we have not seen, at least since like the 1890s or something. And could we see it this time? I think we could. It's a scenario where you have a Democratic president, a Republican Senate, a Democratic House. Now, why do I say we could see it? Well, I think Republicans are going to take the Senate no matter what. I'm not making a political statement. I'm just looking at the elections that are up. Republicans have fewer contested Senate elections this go around. It's hard to upseat an existing senator no matter which side of the aisle you're on, but you have to keep in mind Republicans are -1 right now in the Senate. Manchin's seat is up in West Virginia. A Republican's going to win that seat. So that right there kind of neutralizes the Senate to be even. Tester has his seat up in Montana. This could be the election. I think the Republicans will probably take Montana. I think that seat could get overturned. So if those 2 seats overturn and everybody else holds serve, no matter which side they're on, that's +1. The third seat that might be the one that could have the highest probability of overturning is simply you have Ohio going on. Now you've got a VP candidate from Ohio, so that always makes it a little bit more interesting twist. So maybe even one more that might flip. But again, I think Republicans take the Senate no matter what, which really kind of leaves 2 possible scenarios, right? The one that I mentioned, if Harris wins, probably takes the House, just like I think if Trump wins, he probably takes the House. So you either have a setup of Democratic president, Republican Senate, Democratic House, or you have a straight win on the Republican side. I don't think Democrats can have a straight win because, again, I think no matter what, I think Manchin flips. I think Tester has a high probability of flipping, and I think the Senate flips no matter what. Won't be a huge majority. None of these are going to be huge majorities, but I think those are the 2 makeups that are in play. From a market reaction standpoint, again, we haven't seen that one scenario I talked about, but it would be mixed party. I think the market might be okay with that, at least initial reaction. Probably has initial reaction of positive if it's straight red as well. The bond market might have a different reaction, and I think you're seeing some of that. Because now you get more talk about, well, what might tariffs be if Trump was in charge, and if tariffs are inflationary, interest rates move up. And I think you've already seen some of those moves moving up in fixed income. So who knows? They could reset the other way. I mean, nobody knows in the short run what will happen, but those are some of the dynamics we might see around the election. So let's see what other slides we have in here. We might have one. Let's talk a little bit about taxes, which also are quite frankly get tied in with elections a lot. So under my scenario, we know that the Tax Cuts and Job Acts, the original Trump tax cuts, they sunset at the end of 2025. The only way they stay in place is if it's a straight Republican sweep. If Democrats have control of anything, they won't pass, right? So they either are going to stay where they're at, or they're going to reset back to where they were pre-2017. I think those are really the only 2 scenarios we're talking about. I don't think taxes outside of those items in the Tax Cut and Jobs Act, I don't think anything else will pass. Why? Because I don't think a Republican Senate would pass them. So I think that limits what can happen for taxes moving up that are different than the taxes we already know about. Also, I don't think even if there was a straight Republican sweep, I don't think taxes can go even lower than they're at now because quite frankly, tax rates are at the lows as they've been in like 80 years. And the debt continues to get bigger. It's going to get bigger under both sides of the aisle. No one's really talking about spending cuts. They're just talking about how much revenue they might bring in. But I think Republicans in the Senate and the House would say, look, we can keep the tax cuts in, but we can't go any lower. So I think a lot of things that are talked about going even lower or things that are outside of the box of the Tax Cut and Jobs Act that might go up, taxing unrealized cap gains gets talked a lot about. I don't think it'll happen. Why? Because my premise is Republicans take the Senate, which almost dictates for you what can happen for tax policy, particularly with them moving up. What you see on this slide is capital gains, it'll be capital gains season soon. It's been a good market year, so your average mutual fund might spit out a pretty good capital gain. As you know, for those assets that make sense, these guys have utilized a tax managed solution. And again, whether it's ours or anybody else's, you should be managing your own taxes. Or managing or having them managed for you, I should say, having your taxes managed for you. There are ways to minimize those capital gains that come out. But as you see with the red line, no matter whether markets are up or down, IRS gets paid. So I would assume that there will be cap gains this year. And again, make sure that you're talking to these guys about it. Again, one of the three things I mentioned that you control, right? You control getting advice, you control staying in the game, and you can manage your taxes much more than I think the average person thinks that they can. And I would just assume that taxes overall, because of the lower levels that they're at now and the debt that will continue to accumulate under both sides of the aisle until they really decide to focus on a solution, I think you just have to assume taxes are probably going to stay where they're at or move up maybe for the rest of our lives. So this issue is certainly not going away. And if anything, will get even more intensified through administrations, quite frankly, on both sides of the aisle moving forward. All right, enough about that fun talk. We'll know the answer a lot more in a week or so. I want to end up with this one. I kind of referenced it earlier on. So this just kind of shows at the top. I like this because you can personalize it. Well, pick the year that you really kind of started investing, or pick the year that, again, well, for whatever reason you might want to pick. And then you've got the time horizon or the holding period on the left-hand side. Now, obviously, in a very short period, like 1 year, yeah, if you pick a year and invest and the market goes down, that wasn't the greatest entry point. A lot of people, quite frankly, I think that keeps them out of markets because they're scared of that scenario. And what you see in the dark red, I think, is if you drop 10% or more. The light red is if you drop between 1 and 9. The light green is you went up, I think, between 1 and 9 or somewhere in that range. And then the dark green is you made 10% or more. Those are kind of the parameters for the coloring scheme. Well, what do you see? Particularly, even when you get into 3, but look at 5 years and on. You're either light green or dark green. Doesn't matter when you entered. You could be the best investor in the world. You could have the worst timing in the world. You could feel like I'm always that guy or gal that gets into the markets at the wrong time. And we always focus in on, well, what were the results of the next day or the next month or the next quarter? Because we're human beings, right? We want to say, hey, we picked a good entry point. Time horizon is what we all need to worry about, right? Again, you're going to live through a lot of elections. You're going to live through a lot of earning cycles. You're going to live through Federal Reserve raising rates and lowering rates. Once you get out to 5 years, look at that. And this is a fully diversified portfolio. This is a world index. This isn't just U.S. market. U.S. market's done really well for the last 10 years. We're not cherry picking what we're invested in. This assumes you're involved in U.S. stocks, non-U.S. stocks, emerging markets when they were great, emerging markets when they haven't been great. This is a global 60% stock, 40% bond portfolio. Look what happens when you get out into these outer years. I'm seeing a lot of 6s and I'm seeing a lot of 7s. When you're meeting with these guys, I bet when you're doing planning assumptions, that's pretty consistent with what you're looking to fund your retirement, your goals, and your dreams, right? So again, have some perspective of what markets do in the long run. Time heals all wounds, and it kind of works that way in investing as well. Have a plan, stay in the game, and manage your taxes. So that's a handful. As you see, this is slide number 26. For some of you, it probably felt like we went through all 26, but we didn't. So count your blessings. That's a handful that I've been, again, using kind of as a backdrop for talks that I go everywhere in the country. So if you want the entire deck, you can certainly get it. And again, if you want the election deck as well, which is 8 to 10 slides, you can get that as well too. Just make sure you're talking to these guys and we'll get it in the hands of people that want it. So with that, this is where I think I turn it over to see if any questions might be coming through. I don't know if it's through the chat room or whatnot, but I don't know if I'm turning it over to Sean, might be turning it back over to Jason, but ball's in your court, guys, on where you want to spend the rest of our time.
All right. So far I don't see any questions in the chat. Does anybody have anything they want to share or get some more insight on from Mark?
Everybody accomplished their goal. They had their lunch during the talk. They got through their email. They caught up on all their social media accounts. So I'm glad I could block out a half an hour of everyone's busy day to make sure you could do that stuff in the background. So
I think you nailed it, Mark. I mean, you covered pretty much everything, which is awesome. There's no questions. I was just going to ask, I know it's short-lived at this point. Do you think the Fed's decision to lower interest rates here earlier, is it having the intended effect at this point, or still too early to tell?
it's still early to tell. Again, they're trying to figure out a year from now, were they right or not. I mean, it's a tough call, right? The economy still looks pretty good. The economy is growing 2.5 to 3%. That's about as good as you can grow an economy our size. Labor market has its fits and starts, but unemployment's still in the low 4s. Earnings season, we're wrapping it up. It's been pretty good. We thought it would be. So economically speaking, it's okay. They're just looking at it and going, if we do slow down, I'd rather not wait until the slowdown hits and then start lowering rates. And so they're just trying to estimate. They get it that things are good now, but will they be as strong a year from now? And where will inflation be? And, rates at 0 were too low and 5.25 were probably too high, basically going in the middle somewhere. And I think that's where they want to get to. So hard time to do their job. They probably want this election over as well as everybody else. So at least they can kind of get that kind of data out of the way and know what hand they're dealing with. But yeah, again, they might slow themselves down if they think things are going a little bit better, but it's not a question of where are they going. It's how long is it going to take them to get there? Maybe a year, maybe 2. I don't know. But I think they're going to 3 or 3.25. So we'll see in a couple of years if I was right on that one or not. Of course, that's based on what the world looks like today. A lot of things can change, but where we're at today, so we think that's where their target is. So.
I think the media wants you to think that the U.S. economy is close to collapse in terms of the amount of the federal deficit, which I don't believe is technically true, but an increasing federal deficit sure has the kind of opposite effect. How do you feel about that impacting the fixed income market as we continue to grow this debt? And from what you had said, it doesn't sound like it's going down anytime soon. We got a tough problem there to crack.
Yeah, again, I'll kind of go back to the Buffett answer. 100,000, yes, on the Dow. Just don't ask me the decade. I feel that way on the debt. I don't know if it's a 2, 4, or 6-year issue, but at some point it's a problem. But we get a longer runway in the United States for a variety of reasons than your average country. Our economy is growing. I mean, covering our interest payment is not the problem. The problem is the interest debt will continue to grow from the levels that it's at. And again, it's not a problem till it's a problem, and then it's a problem. So we don't have any problem selling our debt to fund it. Again, whether interest rates are 3.5 or 4 or 4.25, I mean, that's pretty low for the amount of debt we're putting out there. So people are not demanding a higher interest rate because of our debt levels. It's still the most liquid, closest thing to risk-free security out there. There's just no alternative. And I think that's what gives the US some more runway. The treasury market is so deep. And this is without China and Japan even being buyers anymore. And they were such big buyers for a long time. There's just other buyers out there, right? So whether it's the dollar or the treasury, we're just kind of in that unique position where there's constant demand and there's just no alternative for it. So as long as we keep growing, yeah, we can cover the payment, but it's somewhere down the road you kind of cross over. I just think it's further away from us. I mean, we are still the lead economy in the world. We proved again with AI that we're the innovators of the world. We've got energy all over the place. We'll figure out alternatives on mass. I mean, we're a resource-blessed nation, as well as our debt and our dollar still kind of run the world. So it buys us more time than this election. But it would sure be nice to start at least getting closer to deficit neutral and not adding to the debt in a time periods where, times have been pretty good. And I don't think either side really, again, neither side even talks about it. They just talk about how much revenue they might bring in, but they don't talk about cutting spending. So the good news is we get a longer runway and we have more advantages than other people, but eventually, yeah, there's some politicians down the road yet to be named that are going to kind of like Powell. Powell inherited as a central banker a global pandemic. Probably didn't go, tough draw. I think there's a tough draw down the road on both sides of the aisle for some people that eventually are going to have to deal with some problems that are much harder than the stuff that they debate today, I think. And but we know politicians won't deal with it until it's a crisis. When did Europe solve their Russia heavy energy crisis? When Russia invaded Ukraine and it came to their borders, right? That's when they solved it. Unfortunately, that's the way most politicians around the world act. So again, maybe there's some comfort in that. Maybe there's not in the answer, but we'll see moving forward because the debt's not don't count on it going down anytime soon.
Yeah. Yeah.
No matter who wins, not making a political statement at all on that one. Yeah.
We do have a question in the question and answer. Do you see the BRICS impacting the US market?
Yeah. So the old BRICS, Brazil, Russia, India, and China. All the flavor. They were the best asset class if you collectively looked at them for the 10-year period before this last 10-year period where US kind of took over. Then they kind of went quiet, particularly China as of late. China's market's been halved. India, on the other hand, is charging forward now, is the most populous country, I think, in the world. And their weight in markets, so to speak, is right there with China as China's market really collapsed due to COVID policies, et cetera, and India's really kind of re-engaged. So, and those are the big, Brazil's in there as well too. If you look at Brazil, China, and India, I mean, those are 3 of the top 10 economies in the world. Russia is not anywhere near that. They're maybe 2 or 3% of world economy. They get put in there just because of the geopolitical issue that they bring up. Plus, I think they needed an R for the acronym because BRICS sounded a lot better than BICS. So, it's really those other 3. So I do think emerging markets is an interesting space. Again, 85% of the world lives in an emerging market. 85%. And in most places, except for China, they're 10 years plus younger than those of us in the developed world, which is us, Europe, Japan, Canada, and Australia. So I still think the power of the consumer is there. 60% of the world's economy is in emerging markets. So I think in a balanced portfolio or in a more heavy portfolio, I think people should have a slice of emerging markets. They're the kids, right? I've got, again, my kids are 24, 27, and 30, but when they were their teenage years, they felt like in emerging markets, right? I know they're the future, but they're exhausting to live with sometimes on a day-to-day basis. But they'll come through the other side, and I think that's the way you need to look at it. So have a strategic weight to those areas and just kind of put it to the side and just assume that over the next, 10, 20, 30 years that they will continue to become bigger and bigger consumers. We think it should be a piece of maybe not for more conservative investors, but a piece of a more equity heavy portfolio should have exposure, not only those names, but just the emerging markets in general. The rest of Southeast Asia has been in overweight in portfolios. India's been in overweight. Mexico's been in overweight. Some of those markets have done pretty well as of late, but China gets all the attention.
Awesome. You covered commercial real estate a little bit and REITs and kind of what happened in third quarter. How about just residential real estate in general and where that's at currently?
Yeah, I mean, interesting place for commercial real estate, right? I mean, 40% of America owns their home and the rest of us are going to die in our home, right? Because we have a 3.5% or lower interest rate. So it's hard to see a lot of supply coming out because it's hard to see a lot of movement. I think mortgages have to get down to that 5 to 5.5% area, which they will if the Fed gets down to say 3 to 3.25. And I think that might spur people to have more activity, maybe some more supply hitting the marketplace. But until then, it's just hard to see a lot of movement just because of those, again, there's people are staying in their homes. So new home sales have been doing all right, and you can get incentives from builders on interest rates and stuff, but existing home sales have kind of stalled, I think, for some of those reasons. So I mean, I think housing will continue to kind of just be an increasing part of market returns. I don't know if we're going to have that peak that we had and then coming down the other side of it, because I don't think we're going back to a zero interest rate world. I don't want to go back to a zero interest rate world. I don't want the scenario that takes us to a zero interest rate world. That's 2008 and that's COVID. So rates are not going to go back to those really low levels, but I would think somewhere in the 5 to 5.5% area. That's again in the long term, still really nice mortgage rates, and maybe you'll get a little bit more supply added, but we're a little bit of ways away from that.
Great.
Great.
Jason, any more questions in the chat or?
No other questions in the Q&A. Anybody else got anything out there for the good of the order?
Next time we talk, we'll have some answers. At least I hope we do, or we got bigger issues. But yeah, we'll have more clarity on a few things moving forward. And before you know it, we'll be putting out our market outlook for 2025. So always stuff to talk about.
Great. We look forward to that, Mark, and we really appreciate you being on the call today. Thanks everybody for joining us, and we'll see you for the Q4 call.
Happy Halloween, everybody. See ya.
Thank you. Take care.
Thanks, Mark.